the first time. All right, I have got idea, rather I must say a vast majority. So thank you, thank you. So we will be proceeding towards and talk about financial management today. Students, what is the objective to attend classes? And you might be thinking, what type of question it is? Yes, I'm asking you, what is the purpose to attend class? There is only one purpose. The purpose is pass the paper. If this purpose is achieved, it means everything is fine. At the end, if this objective is achieved, it means everything is fine. If this objective is not achieved, it means nothing is fine. Right? So we have to do everything, whatever is possible to achieve this objective. You have trusted me by joining this batch with me, and I won't let you down at my end. This is good news for you, but there is a bad news as well. The bad news is that if you do not work as per my plan, there is high risk that you may not pass. Yes. So good news with the bad news as well. Two sides of the coin. We must see. And we must be able to see that. Now the point is, just 1 minute, please. Now, the point is, students, the point is, on this financial management paper, it requires the steps it requires to pass. In-depth knowledge of everything you study. In-depth knowledge of everything you study, it requires that you have to study every bit of the subject in detail. And not only that, then you need a lot of practice questions, because practice questions are of two types here. There are three types of question in exam, but broadly we can say one is objective test questions and constructive response questions. They are of 30 marks. Sorry. And they are of 70 marks. So the point is, what to do? Which approach we should choose? Objective test questions, there is always one thing. They are conceptually tricky, plus there is some common sense test as well. And there is one way to master that. Practice, practice, and practice. Same is the case here. Now the point is, in-depth knowledge is the baseline. It is the foundation stone. And what approach we need to take? I will be providing you my own notes. First thing, Second thing which we need to study to master this subject is, if you want to study, some students say, I have to study in detail. And I say, okay, that's good. No other book. Then what? The best resource is ACCA Study Hub. And they have given their chapter-wise knowledge. That is textbook, basically. That is a textbook, basically. So this is where our study, we have to study the knowledge, the concepts. Here they are. Second point. The second point is now practice. Sorry. Now practice of questions. What will be the resource? Student, the fun resource is, I will be arranging exam kit for you. I'll providing you. Okay? Most likely Kaplan. But this I will use for some constructive response. CR, I am using abbreviation. Questions. Some. My major focus will be ACCA Study Hub. ACCA Study Hub will be my major focus. When this focus we say, why is this focus? Because it is given by ACCA. OTQs, huge bank is there. Quizzes, bank is there. This is what we will be solving in class. I want you to do all this plus OTQs from here as well. Kit, all OTQs. So if you have, some students may have purchased BPP kit. If you have 1-year-old BPP kit, that will serve the purpose, no worry. 1-year-old kit will serve the purpose. No need to buy another. BPP even work. Means the purpose is, you have to follow all the OTQs, quizzes of Study Hub. You have to do 1 kit OTQs and constructive response question from ACCA Study Hub. That will be enough. Students, that will be more than enough for your passing the paper. It sounds very good. You know, we enjoy passing the paper. Just kidding. You know, so but there is a recipe. Desires are there and action should be there. If you don't put right action, right strategy, you won't pass. You don't achieve your objectives. Okay, now, the point is, once again, repetition. Study the book, notes, refer to the Study Hub, and practice questions. OTQs from 2 sources, Study Hub and 1 kit. And constructive response question from Study Hub. That will be more than sufficient to pass this paper. Yes, I recommend further. 4 latest past papers. Exam papers, which are available on ACCA practice platform. Now, if you do this, there is no power on earth which can help you, which can prevent you to fail in passing your exam. There's no power. So this is your choice now. You have to pass through this process. Remember, there is no shortcut. Through which you can pass the paper, as the paper is well diverse. Let us learn some syllabus content. Syllabus content. So the financial management syllabus, as one of the students told a bit about it, it is related to finance. It has some back linkage of some topics, a few only, with F2, management accounting. But if you have forgotten that, no worries. Here we have to study from scratch. So the first area is investment appraisal. The first area is investment appraisal. The second area is business finance, a big area. The third area is working capital management. The fourth area is business valuation. And the fifth area is risk management. And the sixth small area, very small area, that is some theoretical topics. I give them name, which are related to economics, some economics related topic, microeconomics, macroeconomics, okay, and financial markets. What are the financial markets, right? So what is the economics, and so on. This is the full syllabus in front of you people. So students, now the point is, these three sections, if we say weightage, if we break your syllabus into 4 parts, 4 equal, 1, 2, 3, and 4. 4 equivalent parts mean 20-25% weightage in your syllabus. These have got. Now, let us proceed further. In exam, even they have got almost equivalent weightage, which I have given you 4 parts, 20-25%. In exam, they have similar weightage. So let us proceed. This is my study plan with you people. We will be starting with investment appraisal from here. I have not shared the plan with you. Just a minute. I'll be sending you here. I'll be sending it to you here. Just 1 minute. It will be uploaded on the website as well. Just 1 minute, please. This is tentative plan. It is coming in the chat box. Download it. So, students, investment appraisal, 5 lectures I have mentioned here with practice. And there is first test. Okay? It will mark and return to you. Then business finance area. 4 lectures I have mentioned, but I said tentative, maybe 5. Test 2. Then business valuation and working capital management. Third test. Then risk and other areas. Now, students, we know that during this session, Ramadan is there. And your class timing is that it will be iftar timing, I think, in your country as well. At the time of class, if I'm not wrong. Am I right? Iftar timing. Am I right? No one is replying. Okay, no idea. Okay, no worries. So I have tentatively added this. These classes may be falling in Ramadan. If iftar timing clashed with it, it is 9, it should be on 16th, ideally on Saturday. But I have added Sunday. Why? Because if iftar timing on Ramadan, it is falling during that. And I'm almost sure it will be like this. It will be falling during iftar timing. Then we have to change the time of class. Okay. Just a minute. Just 1 second, please. Just 1 minute, please. I will continue. Just give me 1 minute only. Most likely, it will not cause any problem to me as well. But again, I'm not sure because it will be 6 p.m. here, and at that is the time of iftar here. 6 p.m. Okay? Now. Yeah, it will be. You're right. So then I have decided that I will be conducting class on Sunday. At what time? Tell me on Sunday, during the day it will be. You will be telling me. At that time, we will decide that whether it will be suitable to conduct class at 13 or 12 to means more noon, 12 onwards during the day. Right? So we will decide with mutual consensus. Okay? Mutual consent at that time. So don't worry about it. Okay? So, right. So I'm just telling you in advance that this may happen. Then there is, I have mentioned one thing. 2 to 3 additional practice session I can arrange. Okay? And of course, students, remember what I want. To have maximum practice, I would like to conduct 5 to 6 additional classes, which are practice only. But again, I would like, this is my wish, not necessary. And I will not be charging anything additional for it. Just the purpose. What was the purpose we decided? This is the purpose. Here is the purpose. Okay? For this, I want to do everything which is required. Because in my opinion, these 17 classes are insufficient. There should be ideally 23 to 24 classes which are required for sufficient practice. You got that? Now, so then there'll be mock 1, mock 2, mock 3 mocks, 100 marks. We will be conducting 11th May, first mock, full course, because you have exam in June. Then if you find deficiencies, the next mock and the next mock. 300 mocks we will be conducting. My assistant will be returning it to you, the marked mocks. Okay, now, so this is the success plan. Now, I want to ask one thing from you. I want one thing from you. Yes, that is your cooperation. That is your cooperation in terms of regular in studies, regular in classes. Now, just 1 second. Just 1 minute, please. So, students, there is another point in front of you. So I will make up my mind. I have to plan actually. Okay. So just it is in front of you. Yes, together we can make it. Thank you for expressing your full support here with me. The full class is committed to pass the paper in December, in this June. Yes. Now, so I am starting with investment appraisal section. Students, investment appraisal, the businesses, organizations, they make expenditures. Organizations make expenditure, they spend money. And that money is in the form of revenue expenditure, and capital expenditure. Revenue expenditure is daily based expenses. You have to buy fuel. You have to pay electricity bill. You have to use routine expenses. You have to buy stationery for office. You have to buy milk for the kitchen, for the tea of the staff. Revenue expenditure. Then is the capital expenditure. We are talking about that today. So capital expenditure is huge amount of funds outflow, and it will have significant impact on the cash flow and financial position of the company, look on the liquidity of the company. Funds have opportunity cost. So that's why it is not, so that's why it is required that you have to evaluate well. Evaluate. And who does that? It is finance manager. Evaluate well before making a final decision of investment. Before making a final decision of investment. Because once you have invested, it will not be wholly solely recoverable if it is a bad investment. So you have to evaluate. So investment appraisal, when we start with, so investment appraisal techniques are there. Techniques. There are 5 investment appraisal techniques which are part of the syllabus. One is payback period method, accounting rate of return, ARR. Then is discounted payback. Then is in and net present value. And the last one is internal rate of return. IRR, NPV. These 5 methods are part of your syllabus, investment appraisal techniques. Remember, for each method, we need to know the meaning of term. What is the meaning of payback? ARR, NPV, IRR. Calculation method. We need to know how it is calculated. Interpretation of results. We need to know. And advantages and disadvantages of the method. These 4 things we know. We should learn for each method. If you give me just 2 minutes, I'll be back in 2 minutes and I will continue then with accounting rate of return. Just 2 minutes I will need. Yes, please. Now, thank you for your patience. Students, the point is accounting rate of return. ARR. It has another name. The name is called return on capital employed. ROCE. Yes. Accounting rate of return and return on capital employed. Two names, same, right? It is basically, it tells annual percentage of profit on investment or average investment as well sometimes. Two approaches are there. It is average return in the form of profit. Students, this is the only technique, only investment appraisal method, which is profits based. What does it mean? In which profits are used for calculation. Profits. Remember that. So accounting rate of return is equal to average annual profit the company will earn through project divided by average investment into 100, and where average investment is equal to initial investment in project plus scrap value divided by 2. Divided by 2. This formula you should memorize. Average annual profit divided by average investment into 100. Now, next, let us proceed further. Let us proceed further. The next point is for example, we learned it by an example. Company X wants to invest $700,000 in a machine, which will have its scrap value of 25,000 at end of its 4-year life. Following profits will be generated. Year 1, year 2, year 3, and year 4. 150,000, 175,000, 187,500, 195,000 required. Calculate accounting rate of return of the project. Note it down. Then I'll proceed. If you have noted it down, write done in the chat box. Write done in the chat box. If you have noted it down. All right. So, students, let us proceed. Let us proceed. So, the formula for ARR, we need average annual profit. We need. So, 150,000 plus 175,000 plus 187,500 plus 195,000 divided by 4 year. So average annual profit. Give me answer, be quick. Be quick, give me answer. $176,875. Good. Thank you. This is average annual profit. Now we need average investment. That is initial investment plus scrap value divided by 2. Yes, what is its answer? Good. Average investment. Nice. Accounting rate of return. 176,875. Average annual profit divided by average investment into 100. Give me answer. What is the answer? Right. It is around 48.8%. 48.8%. Well done. So we have learned that how to calculate accounting rate of return. Sometimes, students, ARR has another formula. Yes. One formula we have learned. There is another formula. ARR is equal to average annual profit divided by initial investment, not average. Then we have to put only initial investment. In both cases, answer will differ. If question is silent, question is not telling you whether you have to use average investment or initial. Question is silent, then you have to use average investment. Average investment is preferable. If question is specifically telling you that use initial investment, then we have to use initial investment. Is that clear? Yes, I can repeat. If question is specifically telling you that use initial investment in the ARR formula or ROS formula, then you have to use initial investment. Otherwise, in all other cases, you will be using which formula? This average investment. If question is specifically examiner is asking to use initial investment, then you will use it. Is that clear? Otherwise, you will use average investment formula in the denominator. Yes. Now, students, wherever I am happy, this student asked me, Mr. Hamzah, I'm not clear about it. If you have any confusion, you can ask. Even you can text me on my WhatsApp number. I will give you that, my own WhatsApp number as well. Don't you worry. Okay. Now, so let us proceed further. Company ZTC has to invest in a project. Investment, initial investment, 2.5 million. Scrap value, 110,000. Expected profits in year one are 330,000 and expected to grow by 7% for next 4 years. Calculate ARR of project. Yes. This is another example, right? Example. Now you see here, we need to calculate profits for 4 years. Year 1, 2, 3, 4, 5 years. In year 1, profit is 330,000. Then it will grow by 7% in the next years. Yes. We have to calculate that. It is 353,100. Three double 7,817. You can check my calculation. I may do mistakes on the calculator. Yes. 432,562. So these are the profits. Profits. We have calculated next 4 years. 5 years, sorry. So average annual profit. How to calculate? 330,000 plus 404,264 plus 432,562 divided by 5. If any step is not clear, do let me know. Three seven nine 549. This is average annual profit, right? Now, average investment. Investment 2.5 billion plus 110,000 divided by 2. What is the average investment? Please tell me. The answer? In the previous question, a lot of students were doing calculation, and now only few. I want the same passion. I want the same passion. Yes. Next, ARR, average annual profit, average investment into 100. Yes, what is the answer? ARR. 29.1%. 29.1%. That is accounting rate of return. Next. The next point is students, we have learned the technique, the meaning, and now decision rule. How to make decision. If ARR of the project is greater than target ARR of company. Company has set, company's board, basically board of director, they decide. They decide, okay, we will accept all projects if their ARR is 25% or more. So whatever they decide, then accept the project. We will give decision. Otherwise, if it is less, then reject. Now I will be adding some complexity to it. Some complexity to it. I'll be adding that. Students, for example, you have been given, so I will be writing here, yes, complex example. A bit complex, not that complex, by the way. You have been given a project, its cash flows are here. Cash flows. 750,000, 795,000, 805,000, 820,000. Investment in the project, that is 1.5 million. 1.5 million. Scrap value is 200,000. Calculate ARR. Students, listen carefully. They have given cash flows. What we need? We need profit. In order to calculate accounting rate of return, we need profits. We cannot use them and calculate ARR. Now listen, please. What is the relationship between cash flows and profits? Students, from the cash flow, we deduct non-cash expense. What do we do? We deduct, because cash flows are only cash in and out. Non-cash expense, depreciation, amortization, that is not deducted from it. So we deduct that. And what do we get? Profits. So just see here. Here, non-cash expense is total depreciation. $1.5 million minus 200,000. Because at that scrap value is here. Initial investment was this. So the difference is depreciated. Initially it was 1.5 million. At the end it's 200,000. So difference is depreciated. That is 1.3 million. $1.3 million is the difference, total depreciation. This is the non-cash expense. So total cash flows, how many they are? Cash inflows. So sum of all these four, you will tell me. 1, 2, 3, 4. 750,000 plus 795,000 plus 805,000 plus 820,000. What is total? Yes. $317,000 and then 00. Okay. Thank you. 3.17 million. Right. Now we need profit. So we know that profits is equal to cash inflows minus non-cash expense. You see here, minus non-cash expense. There is non-cash. Depreciation is non-cash. Give me the answer. $1.87 million. $1.87 million. Total profit. It is total profit. How many years? 4 years. So average annual profit. 1870000 divided by 4. 467,500 average annual profit is here. Now, average investment. Initial investment 1.5 million plus 200,000 divided by 2. Divided by 2. Tell me, please. 850,000. Great. So ARR, annual profit divided by 850,000 into 100. Average annual profit divided by average investment into 100. Students, if you think at some point I have been too quick and you are unable to understand any point, don't hesitate to ask me. I will re-explain that. Sometimes it may happen that in a flow of calculation, I may have been too quick from your point of view. So don't hesitate to ask me to explain that again. Is it clear so far? Tell me. Is it clear so far? Great. Now, so accounting rate of return, ARR, its drawback and advantages we need to talk about. We need to talk about its drawbacks and advantages. This method. So students, advantages. You will get the notes by Monday or Tuesday maximum, volume 1. I will upload that. I am just updating some, notes, some updates, necessary updates are in progress. It will be updated on the website. Advantages. Students, it is simple and easy to calculate and understand as well. Very easy. First, it uses profits which are readily available. Yes, readily available profits, data may be available. It involves the familiar concept of percentage return. Percentage return. How much percent you will get? Very easy. And it considers entire life of project. Full, the whole profits. Now, drawbacks. So profits we have discussed. Very easy. Advantages we have discussed. Now drawbacks or disadvantages. Number one, it does not consider time value of money. It does not consider time value of money. No, that is drawback. Going to talk about that. Junaid, it is a drawback. I'm going to talk about that. Okay? Right. So let us talk about the same. It is a relative measure and does not consider the size of project. Note it down, I will explain. I'll explain. What is the meaning? The meaning is, the two projects, project A, project B. It has investment size 2 million. It has 25 million. It has annual profit 100,000. It is annual profit 2 million. Okay. ARR. It has 25%. It has 23%. Based on ARR, which one is better? This one. If we have to decide on the basis of ARR only, we say select project A. It is so ARR is giving incorrect result in terms because the bigger, huge profits more than equal to size of investment, but it is not. It is ignoring that fact. The amount of profit, amount of investment, it is not considering. It is considering percentage answer and making decision based on that. You offer Bill Gates, for example, you offer Bill Gates, I am giving you a project with 70% return ARR. How much investment? You say $1,000. He says, sorry, I damn care. You offer him investment is $30 billion. ARR is 25%. He will come for it. Because huge project. So amount will be big, even percentage is small. So ARR is not considering the size of the project while recommending a decision. Is that clear? So it is a drawback. Relative measure means it is giving answer in percentage, not exact amount. Yes, it is based on profits. Which are subject to manipulation, which can be manipulated. Profit increase and decrease, change depreciation, change amortization, change provision, profit change. Cash flow cannot be changed because cash flow is what is going out, what is coming. Simple. So profits can be manipulated. It is drawback. Target rate is decided by judgment of board of directors. Wherever their judgment is involved, and what is the target rate? This is the target we need. Wherever judgment is involved, their human bias is there, and their chances of error and mistakes are there. Okay, got that? So these are the drawbacks as well. Now I will take a short break of 7 minutes break. You also refresh yourself, close your eyes, do some meditation. Then we will be back. We will talk about payback period method. Okay. So after a short break of 7 minutes, we will be meeting. See you. Yes, now, students, the next topic is payback. So, payback period of method of investment appraisal we have to talk about. What is payback period? Every business is concerned that we are going to invest in a project. How much time our investment will be recovered? The funds we are investing, we are borrowing from the bank, for example. We have to make the payment. We have to plan cash flows. So we want to know that what we are investing today, in how much time we will be able to recover it from the project. So payback period is the time period in which initial investment of the project, of a project, is recovered, is called payback period. Investment is being paid back by the project. For example, we obtain loan. Rationale, just rationale. Let us talk about that. We take a loan of 5 million for 4-year duration. We have to return that money in 4 years' time. Now, projects payback in which we are going to invest, if that is 6 years, we cannot go for the project because we have to return the investment in 5 years. Okay, so that's why it is very important aspect of project evaluation. That's why. Now, for example, that's why we say if payback of a project, period of a project is less than or equal to target or required payback, what is decided by company? Accept the project. Otherwise, reject. Otherwise, reject it. Now, next point. Students, the next point is example. Initial investment is 1.3 million. Annual cash flows from project will be expected for 7 years. That is 2.5 million. What is payback of project? So it is 250,000. So 1.3 million is the total amount required. 250,000 is annually received. In how many years it will be totally recovered? Investment So when annual cash flow is same, very easy. What we did? We did initial investment divided by annual cash flow. So that is the payback period. Very easy to calculate. Can you tell me the answer? 5 point something? How much it is? 5 point? What is the answer? 1.3 million divided by 250,000. 5.2 years it will take to recover this amount. Now, so 5 years complete, and how many months? 0.2 into 0.2 in 1 year has 12 months. Right? It is around 3 months. So 5 years and 3 months. I think this is the exact answer. In 1 year has 12 months, right? 0.2 into 12. Now, very easy. But life is not that easy. Projects don't have same cash flow like this every year. They don't have. Rather, cash flows are different. Practically, this is timeline, and this is the project cash flows. For example, initial investment is 750,000. And then cash inflows are 340,000, 220,000, 210,000, and 195,000. We have to calculate payback period of project. How to calculate? Because cash flows each year are different. What to do? We make another row. The name is cumulative cash flow. We make another row called as cumulative cash flows. Cumulative means total to date, 750,000. Next year, 340,000 recovered. The next year, out of it, 340,000 recovered. What is remaining? How much remaining? 410,000 negative. So out of 750, 340 recovered. Then out of this, 220 recovered. How many remaining? 190 negative. Now you see here, we need 190. Next year there is 210. It means year 3, 2 year complete, and part of year 3 will be needed to recover this amount. How much? We need 190,000. In year 3, we are getting 210,000. Yes. We need 210,000. There are cash inflows are 210,000. We need to 90,000. So how many? So which, this is the part of year 3, which will be kept. Funds needed divided by cash flow in the next year. What is the answer? 190 divided by 210. Tell me. 190 divided by 210. 0.9 here. So 2.9 here. Or we can say that 2 year and 0.9 into 12 months. It is around 11 months. 2 year and 11 months. You see here. It is not difficult at all. Not difficult at all. Any point you want me to re-explain, do ask, please. Should I proceed further? Right. Next. Here is a project. Initial investment is 3.5 million. Okay. Cash inflows are 1.2 million, 2.7 million, 1.1 million, and 2 million. Make it 4.1 million investment. You people will calculate payback. Calculate payback period of project. You will calculate and give me answer. Be quick. Everyone will solve. Okay. Just see here. Some answers are incorrect. We will make a cumulative cash flow negative 4.1. This received 2.9 negative. Point 2 negative. Yes. And 2 year complete. 0.2 divided by 1.1. How much it is? 0.2 divided by 1.1. .18. Thank you. So 2.18 year or 2.2 year. That's good. This is correct. So 0.18 into 12 months. What is it? 0.18 into 12. 2 months. So that's correct. So 2 year and 3 months. Why? Three I have mentioned. Why not two? Preferably, examiner will guide you. If they have tested in OTQs, they will tell you that how you will round off. It is told in the question. So don't you worry about that. Okay? Now, it is done. Next, complexity coming. Complex example. Students, listen. Payback period and all other methods are cash flow based. Only ARR is profit based. Now, just see here. Project A. Initial investment. That is $95,000. Scrap value 5,000. And profits. What I said? Profits are here. 20,000. $35,000. 37,000. 47,000. What is required? Calculate ARR and payback, both of the project. First of all, you will calculate ARR and tell me answer. Be quick. No worries, no worries. The scrap value is 5,000. It is given. Now, all right. So average annual profit, tell me. So ARR calculation, average annual profit. How much is it? Tell me, everyone. Sum of all these four divided by 4. Just verify. If it is not correct, do tell me no. Average investment 95,000 plus 5,000 divided by 2, 50,000. So ARR 34750 divided by 50,000. It is 68 point something. 69.5. Yes. That's correct. Now, students, we need to calculate payback. And one more thing, depreciation is charged on straight line basis. Straight line basis. Now, you see here. So what is annual depreciation charge? Okay, before that, when for payback, we need cash flows. Here, profits are given. We need cash flows. So we know that cash flow minus non-cash expense is equal to profit. We have learned a few minutes ago. So if we need cash flow, it means profit plus non-cash expense. Simple as that. So depreciation is straight line basis. So annual depreciation charge, we need to calculate here. 95,000 initial investment. Now this is from F3. Straight line method. Minus scrap value divided by life. Divided by life. Straight line method of depreciation in F3 you have studied. Initial investment minus scrap value divided by life. 22500. 22500. Right? Now, so project A, cash flows of project A, they become year 1, 2, 3, and 4. 20,000 plus 22500. 35,000 plus 22500. Why I am adding this formula? This formula. Profit plus non-cash expense. So it will be 42500. It is 57,500. Okay? It is, sorry, it is 37. I'm sorry. Yes, 37. Okay, it is 59,500. And it is 69,500. So cash flows are there. These are all now cash flows. Cash flows. In year zero, now, what I can do is cash flows, year zero. Year zero. How much is investment? 95,000 negative. So cumulative cash flows. So 95, this recovered, remaining, how much negative? 47. No, not 47. How much? 50. 52,500. Yes, negative. I will respond your question. Just a minute, Junaid. Let me complete it. Okay? So 1 year complete. In the next year, we are getting 57. So 1 year complete plus part of year two. Part of year two, 52,500 divided 57,500. That needed, it is cash inflow next year. So 1 year plus, what is the answer here? What is the answer here? Point 0.9. So 1.9 year. 1 year plus 0.9 into 12 months. So 1 year, 11 months. Done. The question is, we should not add scrap value in the last year. When I have said these are the cash flows of the project automatically, so it means it is already added there. If examiner says no, it is separate, then we will consider separate. Okay? Net cash flows means, okay? Here we have to add because we are calculating it from profit to that. But that was not needed. Sorry. You are right. Sorry. Here it needs to be added because we are converting from profit to cash flows. So we have to add in the final year. But again, already the investment is getting recovered in the second year. So that is not an issue. Is that clear, Junaid? Right. Next, we proceed. Another question. Example. Investment is 135,000. Scrap value is 25,000. Make it 15,000. Life is 4 year. And depreciation charge is at 20% reducing balance basis. a bit complex, more. Because their depth in charge was quite easy to calculate, reducing balance basis. Cash flows of the project are here. Cash flows. Oh, sorry, profits. Profits are 12,000, 12,900, 14,200, and 17,500. These are the profits. Now focus everyone. So we need to calculate cash flows. And for calculating cash flows, we need non-cash expense, annual depth in charge. So we have to do a working here. Here I will be doing working. Here 0, 1, 2, 3, and 4. Initial written down value 135,000 at the start of year 1. And depreciation 20% rate, 27,000. And then the next year, 135 minus 27, 108 remaining. Then 20%. It is 21,600. Then remaining. Year 3, out of this is 20% is charged. Remaining, how much is remaining written down value here? Tell me. You are using calculator. Be quick. Tell me. Year 3. Written down value at the start of year 3. Tell me, please. 86,400. Thank you. Multiplied by 20%. Yes. How much it is? 17,280. Everyone should be using calculator very well. 4. What is written down value? This minus this. 69120. Of course, I'm happy you are asking. Actually, once again, I will do this calculation. Written down value of is basically initial investment at the start of year 1. 20% depreciation, 20% of it is here. Then that is in the start of next year, how do we get it? This minus this. This minus this, and we get this. Written down value in the start of next year multiplied by 20%. This is the depreciation. Now, written down value at the start minus this. It comes here. It comes here. Then multiplied by 20%. This is the depreciation for the year. Now this minus for the year depreciation, it goes here. Is that clear so far? To everyone. Wherever you feel you are confused, ask me. Is it clear? to everyone. Tell me, please. I need a response from everyone. Good. Some people are not responding. What should I assume about them? Some of you are not responding. Good. Let us proceed. Now, in the final year, reducing balance method of investment appraisal it is. Of depreciation. In the final year, it is compared with scrap value. 15,000 is scrap value. In books value is this. Year 4, according to books, it is for 69,120. It can be sold for 15,000. What is the depreciation or capital allowance? The difference, it will be recovered only. The remaining will be charged as capital allowance, 54,120. This minus this, it will be charged. So we have found depreciation here. These four. These four are depreciation. Is that clear to everyone? 1, 2, 3, and 4. Now, final year, written down value is compared with scrap value. And the remaining is capital allowance. Now, this is basically, one student asked me that I should explain the last point again. Okay. This is basically reducing balance method of depreciation. That in the final year, we do not calculate percentage. Here we were calculating percentage, you see, 20%. In the final year, we just take scrap value, which is given in here, and we deduct from written down value minus, I have posted this sign, minus 69,120, and 15,000 is recoverable only. So the remaining is loss. Remaining should be charged as capital allowance or depreciation. The asset in books is 69,120. What we will get? 15,000. So the remaining 54,000 is loss, capital allowance. Is that clear? Okay, now, so you see here. So we have calculated 4 capital allowances, 4 depreciations. We know that the formula, cash flows is equal to profits plus depreciation. Remember? We know that profits are given. Depreciation we need. Here it is, 27,000 in year 1, 21,600 in year 2, 17,280 here, from here. And the last year, 54,120. I will add, now these are the cash flows. 39,000. 34,500. Profit plus depreciation. Profit plus depreciation. Next is, yes, the next. Here it is. These are the cash flows. Up till now, there is any confusion. I will give you overview. What we did. First of all, we calculated depreciation, reducing balance method. Then in the profits, we added each year depreciation. We got cash flows. Can I erase this end? This I'm going to erase the depreciation calculation. Can I erase that? Depreciation calculation, can I erase that? Have you wrote it down? Depreciation calculation. Okay. Right. Now, students, there are certain, one more thing. There is scrap value of machinery that will also be received in the final year, 15,000. So net cash flows and initial investment. And scrap. Initial investment is how much? 135,000 negative in year 0. So net cash flows. 135,000 year 0. 39,000 positive. Yes. In the final year, 86,620. Now, cumulative cash flows. Cumulative cash flows. 135,000 negative. This will be recovered. 96,000 negative. Remaining. Then this will be recovered. You know, out of 135,000 in year 1, this is recovered in inflow. And the remaining is 135,000 minus this. Negative 96,000 we need. Then is 34,500 recovered. What is the remaining? 96 out of 96,000. What is recovered? 34,500. It is 61,500 negative remaining. Then 31,480 recovered. It is 30,020 negative in the final year. So 3-year complete. 3-year complete. And part of year 4. Part of year 4. 3-year and yes. So it is divided by 86620. 0.35. So 3.35 years. So 3 years and how many months? 0.35 into 12. 4 months. 5 months. So 3 years and 4 months or 5 months, both are acceptable. Not difficult. Only one depreciation adjustment was there. Only one depreciation adjustment was there. Now, I will give you one home assignment, small question. Note down my WhatsApp number. You will solve it on a paper and WhatsApp me the picture. Note down. You will solve it on a paper and WhatsApp me the picture. Now, the next point is assignment. Initial investment is 62,500, 625,000. Scrap value is 37,500. Life of project is 5 years. Depreciation is 25% reducing, 20%. Reducing balance basis. Right? Now, year 1, 2, 3, and 4. Profits are 45,000, 62,000, 64,000, make it 84. And 110,000. What you have to calculate? You have to calculate is ARR and payback period of project. Two things. And you have to take a picture of the page and send to me on my WhatsApp. Okay. Now, I am going to discuss advantages and drawbacks. Advantages and drawbacks of the method. Payback period. Number one, it is based on cash flows, which are more reliable than profits. It is easy to calculate and understand. As well. It reduces risk of company and increases liquidity by recommending projects with shorter payback period. Yes, this method says that this is the project. Yeah, right? You accept the project which has shorter payback. This is approach. Hence, it ensures liquidity, that you have money back, you have your money with you earlier. Liquidity, and the risk is reduced. Risk is reduced. as well, and liquidity is improved. Right. Next, let us proceed further. What are the drawbacks? Or disadvantages? It ignores time value of money. Yes, no discounting. Means just like that, the cash flows which are occurring today or tomorrow, so it ignores the timing. No discounting or no compounding, nothing has been considered. Second, so it may lead to excessive investment in short-term projects. Yes, invest in short-term projects with shorter payback and ignore long-term growth of business. Yeah, it may happen. It may happen. It may happen. Long-term growth may be ignored. Next. It does not consider full life of project. Yes, full life of project, and ignores cash flows arising after payback period. I will explain, don't you worry. Yes. You see here, year one, this is a project A and project B. Both has payback of 3 years. For example, and year 1, 2, 3, 4, 5. And after year 4, so based on payback, we can choose any. So it is not talking what is happening after year 3. What is happening after year 3? For example, project A is giving 400K, 750K. It is giving 10K, 15K. So payback does not consider what is happening here. It ignores what is happening after the payback. Hence, it does not consider full life of the project. This is a drawback as well. Any point which is not clear, do let me know. Yes, students. Is that clear? Is that clear? All right, students. So we have covered today's task assigned: investment appraisal discussion, introduction, ARR, payback. Next Saturday, we will be joining and talking about discounted payback, NPV, and IRR. And I'll be sharing with you the notes most probably by Tuesday. uploading on yes. So I have shared with you my WhatsApp number. You can text your name over here. I can save with your name so that when I receive your message, so I know that who is talking to me. So we will be meeting on next Saturday with the same enthusiasm. Till then, enjoy, yes, your weekend remaining, and see you. Take care. Goodbye. Goodbye. Thank you. Goodbye. Thank you. Goodbye.